Wondering how investment funds like mutual funds, ETFs, and index funds actually make money for you? In this video, we explain how investment funds generate returns for investors in a simple and beginner-friendly way. Learn how capital appreciation, dividends, interest, and compounding work to grow your wealth over time. Perfect for beginners and long-term investors. Hey everyone, welcome back to the channel. If you've ever wondered how your money actually grows when you invest in mutual funds, ETFs, or index funds, this video is for you. Today we'll break down how investment funds generate returns, how you benefit as an investor, and which type of fund might be right for you. So grab a notebook, hit the like button, and let's dive in. What are investment funds? First things first, what are investment funds? Investment funds are pooled investment vehicles. That means many investors put their money together into one large fund, which is managed by professionals or algorithms. These funds invest in a variety of assets, like stocks, bonds, or a mix, based on a specific goal or strategy. There are three main types. Mutual funds, actively managed by a fund manager. Exchange-traded funds, ETFs, passively follow an index like the Nifty or S&P 500. Index funds, a type of mutual fund that mirrors a stock market index. Ways investment funds generate returns. Now let's talk about how you make money from these funds. There are four primary ways. 1. Capital appreciation. When the value of the fund's assets, like stocks, increases, the net asset value, NAV, of the fund goes up. This means your investment is worth more. 2. Dividends. Some companies give part of their profits as dividends. If your fund holds dividend-paying stocks, you'll receive a portion of those dividends too. 3. Interest income. If the fund invests in bonds or debt instruments, you earn interest. This is more common in debt mutual funds or balanced funds. 4. Compounding. The real magic: if you reinvest the returns back into the fund, your money starts earning on itself. This is called compounding. Over time, it can dramatically grow your wealth. Real example of returns. Let's look at a real example. Suppose you invested 10,000 rupees in an equity mutual fund that gives 12% annual return. After 1 year, 11,200 rupees after 3 years, 14,049 rupees after 5 years, 17,623. That's the power of capital growth plus compounding, and it's even better if you invest regularly through SIPs. Things to watch out for? From Well Frames and Viad's Toms. Remember, returns are not guaranteed. Investment funds are subject to market risk. If the market goes down, so does your fund's value. Expense ratio. Every fund charges fees, which eat into your returns. Fund manager performance. In actively managed funds, your returns depend on their decisions. Final tips and summary? To summarize, investment funds make money through capital gains, dividends, and interest. Reinvesting your returns leads to compounding, which multiplies your wealth over time. Choose the fund type that matches your goal, time horizon, and risk appetite.